welcome to this week's episode of Coinscrum Markets. I'm Teana Baker-Taylor. Coming up, Coinless Matthieu Joey Duvall returns to review the markets this week in crypto RFQ. I'll be speaking with Neil Van Heus from BlockFills and Danny Kim from SFOX to discuss liquidity in the crypto markets. Alex Batlin returns to speak to Greg Prisco from Maker DAO. And ByteTree's Jamie Bennett is back to look at this week's on-chain data. But first, a look at this week's blockchain industry news. Tether, the $7 billion market cap stablecoin, was back in the news this week. A New York Court of Appeals has ordered its state's attorney general to investigate a number of businesses related to the token issuer as part of a long-running standoff between the two parties. London-based digital asset market maker Wintermute got a boost last week when they closed their second funding round of the year, closing $2.8 million from Silicon Valley veterans Lightspeed Ventures. In more news from London, trading infrastructure firm Copper made life easier for crypto fund managers with the launch of its actively managed certificate product that simplifies the process and lowers the cost for issuing a regulated basket of assets that can be traded and cleared across a range of European exchanges. US-based custodian Kingdom Trust, who offers Bitcoin-based retirement accounts, has partnered with Fidelity Digital Assets, who will act as the custodian for holders of self-directed IRAs. And finally, Bitcoin miners, already under pressure since the halvening, felt the pinch further this week when network's difficulty level for mining new coins hit an all-time high, primarily due to new generation and more efficient mining hardware generally coming online. Next up, I discuss liquidity in the markets with Neil Van Heus from BlockFills and Danny Kim from SFOX. I'm pleased to welcome my guests, Danny Kim, Head of Revenue at SFOX, and Neil Van Heus, Director of Sales and Institutional Trading at BlockFills. Hi, gentlemen. Thanks for joining us today.
Hey, Teana. Thanks for having us.
Thank you.
Ah, great. So we're going to talk a little bit about liquidity in crypto markets. Just to set the scene a little bit, the level of liquidity in any asset class is important, obviously, for any trader or investor. But liquidity, even in what are perceived to be the most liquid markets, can evaporate in an instance when an information deficit occurs. The flash crashes in global stock indexes in 2011 is a good case in point. So given their relative short lifespan, crypto markets, especially the top few most dominant tokens, do seem relatively liquid, even when compared with many well-known traded traditional asset classes. So your firms have each been in the market for some time, and you both come from traditional backgrounds. So Danny, let's start with you. How do you think that the crypto spot markets compare to traditional markets, say, 3 to 5 years ago versus now? Have they grown in liquidity? And how has that growth, in fact, impacted businesses over this time?
Yeah, sure. So, when you compare to crypto markets to traditional markets, it's actually quite interesting because if you look at the traditional markets, unless you're paying for services, you actually don't know the liquidity behind it, right? Like in crypto, because this was actually started by, engineers and people who focused on the computer science aspect, you actually have a lot more in-depth information available, right? You can actually see order book depth. You can see what the top bid and ask is. If you're trading on Fidelity or any other platform, all you really see is the top of the book price, and that's it. You don't really know exactly what's behind it. Yeah. Now you're kind of seeing where, in crypto, like that market where transparency has been growing, it's expanding, right? Now you're seeing more platforms out there trying to be even more transparent, where you could ultimately see what true liquidity is available. And from 3 to 5 years from before to now, liquidity has grown tremendously, right? What we've seen is that, heck, if you try to buy, 100 Bitcoins in two to 3 years ago, you'd move the market instantly, right?
Yeah. Yeah.
I mean, you've seen multiple flash crashes every other day. But today, people will say it's, if you try to move Bitcoin or Ether, it's fully liquid. It's a lot more comfortable.
So, Neil, what are some of the challenges in accessing liquidity in the markets versus crypto markets versus traditional markets? So it sounds like we're going in the right direction, but it's obviously not perfect.
Yeah, absolutely. So, I mean, if you look at 2016 and forward in traditional markets, liquidity actually changed in a number of different asset classes. I was trading actively almost every major asset class in 2016. And when futures clearing merchant rulings with the CFTC changed on leverage and settlement, going from T+3 settlement down to T0, liquidity totally changed. And so I would say that in some traditional markets, liquidity has actually become more poor and has pushed participants out of the marketplace. Whereas in crypto, 3 to 5 years ago, the amount of firms that were really playing in the space was very small, and they were completely controlling the market. Today, I would say not much has changed from the ideology standpoint. There are still a lot of firms that control the market, but there's 4 to 5 times more players than there was 3 to 5 years ago. So that liquidity has expanded. There's been more traditional players that come in, bringing reputable balance sheets and reputable business practices into the space. And so I think today we've expanded quite a bit, and I would say 4 to 5 orders of magnitude greater than 3 to 5 years ago.
Yeah. So talking about that time. Improvement, trading has become very automated, and most of the leading crypto or the leading market makers are now getting into that crypto space. So without the same level of regulation that we see in other markets, we talk a lot about, are the order books really reflective of what's in there? Is the advertised liquidity real? Is it easy to fill these large orders? Is liquidity being manipulated in some way? So maybe each of you could give me a view on what you think, what your experience has been about how the order books are behaving.
Yeah, sure. I'll jump in. So that's the thing, right? So I think there's two parts of it. I think the conversation has always been more about, is the actual volume true or not, right? Is that volume being manipulated versus, what's actually on the order books. On the order books, I would say, there are various different activities out there, but again, because of transparency, you can actually see what's available, right? And if someone is flashing orders, you can actually see that, because you'll see 500 Bitcoins on one side, and then it'll immediately disappear and go back. So when I say when you're looking at order book activity, you can actually see truly what's going on. Trading volume is what I think it's a little bit different because you don't know exactly who's actually trading on that side or not. Now with that, I would say that I think that the order books in generally have improved a lot. Spreads have drastically improved over the years. Each exchange across the market, you could see that they have tightened. Depth has increased significantly as well. And along with that, it's I think if you compared it to say 2-3 years ago, there were constant arbitrage opportunities because order books just didn't have enough liquidity, right? And the sophistication just wasn't there. Now you've seen that the arbitrage opportunities, especially for the top 2 coins of Bitcoin and Ether, have gone down significantly. And the reason being is, going back to the last question of it's being able to access liquidity better. The exchanges have been able to facilitate, and OTC providers have been able to facilitate better liquidity for other markets to enter. And then as well as the exchanges have been able to support these and build these infrastructures where they could build a stronger order book. But I think that, I think the question of volume, is it real or not? I think that's always up for discussion. But yeah, that's kind of what I see right now.
Neil?
Yeah, so I think, one of your previous questions was what kind of challenges are there to accessing liquidity? I think if you take a look at this space relative to the traditional markets, you've got, an incredible amount of trading venues in which you can choose from to access liquidity. Yeah. Whereas in traditional markets, you might access CME Group, NYSE, ICE, etc. There's one traditional product, one flagship product in the world, and everyone's trading it on one exchange, right? So accessing liquidity comes with a lot of different choices, right? And so now, we kind of approach liquidity slightly different. We consider ourselves an organic source of liquidity because we don't source any liquidity from exchanges. So although market makers who do business with us directly do business on other venues, we are in complete control over our liquidity selection because we have market makers writing into us directly, or we write into a market maker's API that they provide to us. So when we aggregate a feed and we disseminate that feed out to our client base, a couple of things occur. One is market makers or high frequency traders are not allowed to trade against themselves. And so what we do is we submit orders and check order sizes and check order execution availability with each market maker algorithmically as we push an order to the market. And so by doing that, number one, you reduce slippage because they either accept the order or don't accept the order. And if they do, it's filled. If they don't, we route it to the next available order of that size or greater. And so when we disseminate this order feed to our clients, we don't have any market makers constantly hitting each other over the head to try to decide where the market is. You've just got a book that you can execute against. Yeah. So we have very low slippage, very reliable executable quotes without high frequency always trying to decide where they want to be in the book. So that's number one. Number two is all of the orders that are placed in our ecosystem are anonymous. And so when you put 100 lot on the bid to buy at 9,300, no one knows that order is there. And when the market makers come down and cross it, they don't know what the size of that order is. They're just moving their quotes to where they're willing to do business. And if it's crossing our order, it's filled.
So let's move over to the derivative space. So we've seen an explosion of growth in the unregulated crypto derivatives markets and the emergence of products such as perpetual swaps, enabling people to trade pretty significant leverage. Excuse me. So how real is that advertised liquidity? And with the growth of CME futures, for example, how interconnected are the regulated and unregulated markets in the derivative space?
Yeah, sure. I guess I'll start. I think that it's an interesting landscape. We don't work with any retail folks, so our look into the landscape I think is very one-sided. When we talk to professional traders, hedge funds, institutional traders, etc., they really tell us, yeah, we're not really looking for another perp out there in the world. We're not interested in 100 times leverage to take a position. We're just market making. And so I think if you look at those highly levered positions, the demand is on the retail level or on the low level professional that is looking to try to outperform. If you look at what the majority of institutions we work with in the space, they're very happy with a CME product. They're very happy with a product like CME's product. So from a regulatory standpoint, we have an unregulated platform. We have a regulated platform through our FCA regulated broker dealer in London. What we're trying to bring to market is something that looks a lot like a traditional product, that acts like a traditional product, that has traditional clearing mechanisms and margin protocols in place that are not just blowing people out. And I think that the best point I can make on the side of liquidity in the traditional perpetual swaps is liquidity is real until it's not. And that's basically all I can really say about that product is they're making markets very happily and it's very liquid until they get to a point where they see the market extraordinarily one-sided. And at any given time, a spot market or a derivatives market can lead the market. And the reason for that, in my opinion, is because we don't have one core exchange, one core product like we do in more traditional markets. At any time, a massive order could take place on one exchange where people are reacting to on various other exchanges.
Let's shift a little bit to DeFi. So DeFi has become all the rage. Platforms like Synthetics claim on their website to provide infinite liquidity. The Balancer automated liquidity pool got hacked. Traders are being incentivized to provide liquidity via token rewards, for example, through Compound, and potentially illiquid tokens on one network are being locked up as collateral on another network. So is this a good thing or a bad thing or an accident waiting to happen?
Yeah, I'll jump in. I mean, just going back to what Neil said, like I think it works until it doesn't work, right? And we've seen, like, I think DeFi right now is becoming very, very popular. It's a thing where, you know, everyone believes in and wants to get into, and that liquidity, it's good, it's there, but it's still very early, right? We don't, like, it's like everything that starts off as a new product. You know, the idea is always great, but there are always still certain flaws that need to be, you know, checked out, and unfortunately, there will be accidents that do happen.
So Neil, do you think, you know, liquidity providers get paid to make markets on traditional exchanges? Is this just a programmatic equivalent?
Yeah, I think you could kind of look at it that way. And there's an old saying for those of us from capital markets, liquidity begets liquidity. And so I think that's kind of what you have here is, as long as there's liquidity, more liquidity will come. And so it is, I think, a little bit of a programmatic description of that. One thing I would just say is that, you know, DeFi, while I think inherently it's an incredible idea, incredible concept to build for the future, what we see in more traditional markets is only certain players have certain access to certain products, right? And today in DeFi, I think that opens that up completely. Yeah. What we'll find along the way is things like we saw in, you know, crypto early days were accidents, where certain players don't understand certain products, which is why traditional markets tries to protect people from certain products. You'll find that people will get hurt. People will not understand things. There will be security measures because of oversubscription and mass adoption. And I think that's the thing that I dislike most about DeFi right now is platforms that try to grow too fast, too early, and don't have the right security in place. It's one thing to get hurt on a trade. I know that all too well. I'm a trader. I take risk for a living. It's one thing to get hurt on a trade. It's another thing to get hurt from not having the right technology and security in place. So our hope is that while DeFi is very immature, we hope that it expands. It has a ways to go, in our opinion. And we're trying to bring liquidity to yield enhancement strategies through our structured product division in a slightly different way, which is a little more centralized, a little more institutional, which is where we sit. But, you know, DeFi can certainly bring a lot more to the broader market.
Well, we'll see. Still very early in the DeFi space, I think. Danny, Neil, thank you both so much for joining us today. It was a real pleasure.
Thank you.
For having us.
I'm delighted today to be joined again by Matthieu Duval from CoinList. Hey, Matthieu, thanks for coming back.
Hey, Teana, how are you?
I'm great. So today you and I are going to get into DeFi. DeFi has just become all the rage. Everybody's talking about DeFi. Some really interesting things are happening. I think the latest figure that I saw was that the market cap is basically more than doubled over the year and is currently sitting at about $2.5 billion. Is that right?
That's correct. Very impressive figure. We breached $1 billion back in winter 2020, and people said, "Oh, you know, it's because of ETH USD rallied a ton." So actually, it's actually the same platform, the same use. Now it's hard to put that argument forward because ETH has been, just like Bitcoin, very stable in the last couple of months. So really, this growth has been spurred by two projects which have taken off. Maker has gone from a 100 million market cap to 200 million market cap, essentially allowing the stablecoin to grow. And of course, Compound has grown its asset base by a couple of order of magnitude. So to be completely clear, Compound, you can see two different figures. You go on the website and it looks like they have $1.6 billion of assets being lent at the moment. And then you go on CoinMarketCap and you look at it and it's only 600 million. The reason for that is that there is a lot of self-leveraging happening on Compound, meaning you can lend and borrow from yourself and repeat that process over and over again.
Sure, why not?
Why not, right? Which actually leads me to the point of that segment, which is there a trade here? Is there money to be made?
Yeah.
And when you look at Compound today, it's super interesting to see that borrowers are paying currently overall per day around $80,000. All the borrowers on Compound every single day are paying 80K in interest rates, right?
Mm-hmm.
But at the same time, they're also being paid comp tokens for borrowing on the platform, and the aggregate value of that comp token being distributed is $250,000,
Mm.
4 times more. So it kind of goes to show, well, actually, people who come on Compound really come for that comp token being airdropped to them every day, and not necessarily for the actual use case of the smart contract, which is lending and borrowing.
Yeah. Well, I spoke earlier with Nils and Danny about liquidity specifically. And, you know, so if you take a look at like synthetics, I guess it's called, yeah, synthetics,
Mm-hmm.
advertises infinite liquidity, right? And so you've brought up Compound and traders being incentivized to provide liquidity via token rewards. And I asked them, you know, is this world, this DeFi space, you know, waiting for a fall that they don't know is about to happen? You know, is this a good thing? Is this liquidity real? What's your view?
So the liquidity itself is actually verifiable. That's the beauty of DeFi. You don't have to trust a market maker to tell you, yeah, we have a lot of liquidity. You can actually see what's in the pool. So the concept of those liquidity pools being kind of, you know, coming into existence on Balancer, on Curve, are actually very, very interesting. Anybody can commit their asset to these pools and earn a revenue depending on that pool trading volume. So for example, let's take a very simple example, a pool made of USDC and USDT. You bring in 50K USDC, it's swapped into USDT, or part of it is swapped into USDT. And now anybody who wants to swap the asset for the other goes into the pool, puts A, gets B, and pays a trading fee for that. That trading fee is split between the pool participants. So that product makes a lot of sense. It's great because it gets people who were hodling a lot of crypto to withdraw that crypto and actually put it to good use in the market. Now, of course, with the rise of all these assets being taken out of these ledgers and coming into these pools, of course, the yields are going down, right? So the actual trading fee that you earn from that pool usage is close to nil. It's about 0.5%, for example, right now on a Bitcoin pool, which is very, very small. Now, the airdrop tokens are, of course, the main appeal for these pools. But for example, Balancer and others have a program that runs up until only the next 6-7 weeks. After that, no more token. What will happen after that? Not necessarily a wave of liquidation, but the yields will be a lot less attractive. So it remains to be seen exactly what the market, where does it reprice in terms of, do you prefer to keep your tokens in your ledger, in your own safe custody, or do you trust these protocols to keep handling your assets like that, despite having no yield?
That's a great question. So how does the market react to things like when, a automated liquidity pool like Balancer gets hacked?
Right. Actually, it looks like the market is very forgiving. Those pools, some of them were hacked, but others have just continued humming along, and the growth hasn't gone hockey stick as much as it could have been maybe without the hacks. But it looks like participants are just so obsessed by that idea of yield farming that they're very forgiving and just attracted to that new token, getting the token, selling it, and realizing a quick buck.
Okay, so what should we look out for in the market over the next coming weeks and months? What is the good trade?
So I think interestingly, when the comp token was launched about now a few weeks ago, the funding rates on FTX to go short the comp token were so negative. They were a couple of percent points a day, which means that if you wanted to be short the token, you had to pay annualized something crazy like 60 or 70%. That is not the case anymore. With the token having divided by 2 roughly in price since launch, from $350 to currently $165. So I think comp is a bit of a victim of its success. Everybody's looking at the comp token as the barometer to DeFi health. Comp, it has gone down steadily every single day. It's currently at $165. The intrinsic value, which could be defined as, hey, how much money is comp actually generating? If that value was put into the comp tokens, how much would that be? It's around $20, $30. So you still have a good amount of room there. So comp is the number one thing you want to look at. If comp starts really going down, it means that all those yields generating opportunities are going down as well. Is Compound going to keep the same amount of AUM in its smart contract when the airdrop doesn't work anymore? It's going to be very, very interesting to see. The next opportunity, of course, is looking at these liquidity pools and seeing how those yields going to hold when volume starts picking up again, because CeFi is the same issue. Bitcoin is not moving, right? Implied vol, realized vol, everything is super depressing right now. What happens when things start trading again a lot? And are these yields, you know, a good profit opportunity? It remains to be seen.
Okay, great. It's always a pleasure. Thanks so much for coming back.
Likewise, Teana. Bye-bye.
Bye. The wave of innovation and experimentation in DeFi will no doubt continue for some time yet. It could be argued that the genesis of this ecosystem was the launch of MakerDAO and its dollar-pegged currency, DAI, in 2017. Alex Batlin was joined this week by Maker's Greg Prisco to discuss how the project has evolved since its beginning and where it's headed to next.
Hi, Greg. How are you?
Hey, Alex. I'm good.
Would love to kind of get you very quickly introduced for the audience. If you just say a little bit about yourself, that would be awesome.
Yeah, sure. So I'm Greg Prisco, and I'm the head of business development at the Maker Foundation. The Maker Foundation produces the software that powers Maker DAO, which is the decentralized application that produces DAI, the stablecoin.
Pretty much any functioning economy starts with money, with cash. And from my point of view, and others argue as well, Maker has become that foundation for kind of stable coins alongside the kind of fiat-backed currencies as well. So I'd love to kind of get you to explain a little bit about Maker, how it works, how's it different, what are the benefits? Would love to get your insights into that.
Yeah, and it's interesting that you say any economy starts with cash, because I would further that statement to say that any economy starts with credit, and that credit usually turns into cash. And you know, the other fiat stablecoins, they allow us to port credit from the legacy economy onto the blockchain. Where MakerDAO is very different is that it actually allows the credit to originate on the blockchain. And that's kind of our primary innovation, is that, you know, the entire financial ecosystem is contained in this application.
So what are the kind of the pros and cons of this approach versus kind of fiat-backed stablecoins?
Well, with fiat-backed stablecoins, you have basically an unlimited amount of liquidity. You can create and redeem them at will, and there's no limit to how much supply they can have. With something like DAI, its supply is limited by the availability of good collateral and the credit demand on that collateral. And this is the same thing in the real world. It's just done at a much more macro scale. So if you are looking at the decisions that the Federal Reserve is making this week, they're probably looking at the money supply and the available collateral that they have and the credit that can be created against it. It just so happens that they're monitoring this on a global basis, where, you know, MakerDAO is monitoring this on a very small scale.
But I guess, you know, nowadays when Maker started, it was a single collateral mechanism. Now it's a multi-collateral. Does that pose risk? Because, you know, we knew the amount of Ether available, so you knew that the underlying asset could not be inflated by a central issuer. As we go into multi-collateral baskets, that potentially introduces risk, or what's kind of, as you evolve Maker, let's hear your thoughts on that.
Well, so first of all, you know, we started this 5 years ago, and in the original white paper, we said that this has to be a multi-collateral protocol, and this was from lessons that were learned in the past, specifically through a previous token called BitUSD on BitShares. And it turns out actually that adding more collateral is what reduces risk, not adds it. Because when you have one type of collateral, you are exposed to every type of tail risk that you can't imagine. So just to give you a few, with Ether, sure, it has high volatility, and even if you could adjust for that in the parameters in the system, you can't adjust for existential risk, like, you know, shutting down centralized exchanges or you know, the blockchain malfunctioning. You know, and we are running on Ethereum, so it's a bit different in that context. But the point is that any single type of collateral will have tail risk that you can't anticipate. And the only way to get rid of that tail risk and to make sure that your currency is stable in the long run is to diversify away from any single tail risk to the point where it's basically non-existent.
So remind me, what are the assets today that you can use to collateralize Maker?
Yeah, and keep in mind, today is still we are on, like, if you're looking at a long river of stepping stones, we are like halfway to the first stone. Right now, there's about 7 different assets, I think, that you can generate DAI against, but with the exception of other stable coins, almost all of them are very correlated to crypto. So Bitcoin is our second largest after Ether. We use wrapped Bitcoin from BitGo. Yeah. And then after that, it's other stable coins. And after that, it's a bunch of ERC20 tokens that have a very high correlation with ETH.
So I guess in terms of, what are the other factors that you think is going to make good collateral good? Is it market liquidity, on-chain scalability, connectivity? What are they signs of good collateral kind of going forward?
Well, the first sign of good collateral is demand for credit in the first place.
Yep.
You don't want collateral that nobody wants to borrow against. So once you've eliminated all the ones that people don't care about and you have your list, then I would say it's ones that the legacy economy is not pricing correctly. And this, frankly, was our core competitive advantage with Ether. The legacy economy didn't understand it. And we did. And our more specifically, our community of governance token holders did. And they were able to very competitively price out these DAI facilities against Ether. And that's what led to the initial growth of DAI.
I guess one of the kind of concerns and sometimes issues that people raise about is, with central money, you've got the monetary policy, and the monetary policy is kind of maintained by the Fed or whoever is doing that, depending on your jurisdiction. They get it right, they get it wrong sometimes, but at least you kind of know who's doing that. Who is kind of governing the monetary policy of MakerDAO and many other kind of projects, and how decentralized really is it? Because the accusation is it's not quite as decentralized as a lot of people make it out to be. So I'd love to hear your thoughts on that.
Well, it's quite decentralized. I can tell you that firsthand because a lot of the things that I want to happen don't happen. So,
yep.
That's, by the way, that's the number where you know you're decentralized, when all of your ideas get shut down by your own community. Yep. But beyond that, Maker actually doesn't have its own monetary policy at this point. Because DAI is pegged to the dollar, we piggyback entirely off the Federal Reserve. So you can almost think of us as just an extension of this dollarization that's been happening in the world. In the future, there's always the potential that they could peg DAI to something else. But as long as the dollar remains king, I don't see why anybody would do that. What the Maker holders do, and when I say the Maker holders, in our system, we have this group of token holders called MKR holders. Mm-hmm. And that's why I say it's very decentralized, because I don't think that there's any single holder that has greater than 10% of the supply. And even then, the people that have more than 3%, there might be like 2 or 3 of them. So what they do is they manage the money supply. And in order to do this, they have to basically say, okay, the Fed's policy is this. So we need to meet this dollar mark here. And yep. Then what do we do to make sure that our supply is in line and our interest rates are in line to make sure that DAI trades $1? And that's why we say we have a soft peg, not a hard peg. Because yep. There's no point where you can actually redeem DAI for dollars. We're not in the Fed's payment network. But the goal is that through this decentralized governance process, over the long term, DAI will be $1 most of the time.
So I guess that kind of one thing that the community, the Maker community, the Maker token holders can do is decide how much collateral, over collateralization you have. So how does that, who decides, how does that work? Is it 150%? Is it 110%? Is it 200%? Who makes that call?
So the Maker holders make every call in the system. Right. Nothing is delegated to a centralized party. So, and that's part of the scaling challenge, is to make sure that they have the ability to do this when the collateral portfolio is thousands of assets. And because of that, we've introduced something called the Maker improvement proposals. And these are a very rigid framework to follow in order to make these decisions more rapidly and efficiently. But when they're setting that, we like to say that they're following a process called scientific governance and risk. And this is where we really differ from our legacy competitors, where everything we do is out in the open. There's no black box. It's not like you're going to a bank executive and saying, what's in your portfolio? And they say, well, I have a vague idea, but I couldn't possibly tell you the details. With Maker, every single detail is a click away in Etherscan. So it's almost like you can click into the balance sheet of the central bank in one click.
So I'd love to kind of see your evolution of your governance design from the lessons you took out of BitShares and from the lessons you kind of took out of the March stress test and how you think about going forwards.
Yeah, I was going to say, if March wasn't stressful, then I don't want to be around for the and also, I should just clarify. So we didn't, the Maker team never worked on BitShares properly. There was some overlap in the early days with our developers that had previously worked on BitShares.
Yeah.
But I think a lot of the original team members from Maker were strong BitShares community members. And in DAO world, it's hard to differentiate between a core team member and a community member sometimes. So I just wanted to put that out there. But yeah, one of the core lessons, at least that I learned from BitUSD, is you need two things. You need a strong business community around your product. You can't just assume people are going to use it. And you need to diversify into multiple sources of collateral, because having one, and back in those days, it was just BitShares was the only collateral. You simply can't account for all the risk. And if you can't account for all the risk, the only way to protect yourself is through diversification. So the two takeaways from BitUSD for me were multiple forms of collateral, as many as possible, and also a strong business community around your product where you cannot just build technology and assume people are going to use it. You have to help them.
Gotcha. And then what are the lessons from the stress test? Because a lot of the time people are saying kind of people couldn't meet margin calls, the oracles didn't quite perform. What are the takeaways, and what are your roadmap items on the back of the
well, so the very specific takeaways from that stress test were the auction parameters needed to be updated, because even though a lot of the issues were with the Ethereum network, they were because of a very short auction time frame.
Gotcha.
And if the auction time frame was longer, it probably would have played out differently. But the long-term lessons from that were a complete reaffirmation of our vision, which is that you need multiple collateral types, and B, the idea that governance is just as important as we always said it was. Where if you had an active governance community, and something really interesting that happened with March 12th is before that, governance was kind of, I don't want to say dead, but it was quiet. People were just going through the motion. There was very few participants. Since then, we have had an exponential growth in our governance community. People really care now because they saw that their input matters. And I think when you show somebody that their input matters, they're much more likely to participate.
Cool. Now I think that's really good to understand. So I guess moving on to a little bit about, one of the things which I personally really love about DeFi is the ability to kind of modularize finance and then plug it together.
Money Legos.
yeah, exactly that. But of course, that kind of comes back to the old problem we have in centralized finance of hypothecation, re-hypothecation, re-hypothecation, and then you lose track. So, you take your Bitcoin, you wrap it. Once you wrap it, you use it as collateral and DAI. Then you take your DAI and you put it as collateral into compound finance. So you get CDAI, and then you use CDAI to create a derivative product on UMA project or something else. I mean, gosh, how many risk factors do you combine in one? How the hell do you understand all the kind of attack vectors and risk vectors and all that? So I'd love to hear your thoughts about kind of how can we have this modularity, which is really great, but also how can we reduce the risks so that we don't, go back to the 2007 financial crisis just reinvented on blockchain.
Yeah, and this is where we have to get a little bit philosophical in that if you look back to the great financial crisis, I think it really separates into two camps of people that, where to point the fingers. You have people who think that it was the complexity of the products that were the problem, and people who think it was the opacity of the products that were the problem. I firmly fall in the latter camp. I don't think that complexity in and of itself is a bad thing. Complexity is only bad when it's hidden.
Yep.
So the problem with the great financial crisis is that you had a mortgage-backed security and you had no idea what was inside of it. If anybody could have gone on, let's say, Etherscan and clicked into that mortgage-backed security and said, oh, here are these specific mortgages backing this, I can tell that 10% of these are actually worth what they say they're worth, then it was a lot easier to blow the whistle on there being a problem. So for me, the fact that in DeFi, everything is by default transparent to almost, to its core, that to me makes the big difference.
So I guess kind of double back on the previous point that you got the end users of the DAO mostly retail right now, but the kind of the credit side is institutional. So what do you think needs to happen? What are the key barriers to break down for institutionals to come into this space?
We have to, and when I say we, I mean the entire maker community needs to make our products work in a way that they can use without too much of a difference between what they do today. I think something nice that I heard once was you should never ask somebody to do something that's more than one standard deviation outside of their comfort zone.
Yep.
So if using MetaMask is one standard deviation outside of your comfort zone, we can't ask you to do anything else. So we have to bring the usability level to where it meets them in the middle, not us. I think a lot of blockchain right now has been, let's educate them to act like us, where that's not what an executive at a company wants to hear. They're busy, they have a lot to do. They need things to work the way that they're used to working. Otherwise, it's just not worth the cognitive overhead and the risk of doing it to them. Thank
you so much, Greg, for joining me. I wish you success building the amazing product you guys have been building.
You too.
So much. Back to Teana.
For having me.
Next up, ByteTree's James Bennett is back for this week's On-Chain Reaction.
Thanks, Teana. This week in On-Chain Reaction, we're going to delve into the miners ecosystem. Miners are an integral part of the Bitcoin network. They're the ones responsible for taking transactions that you and I send and mining them into a blockchain. So having a healthy mining economy is very important to the long-standing nature of the Bitcoin network. So we're going to look at 3 different metrics today from the ByteTree terminal in order to evaluate how healthy the mining ecosystem is looking. So the first metric is called miners rolling inventory, or MRI. The miners rolling inventory looks at the inventory position of miners over different time periods. So we could look at it through a day, a week, a month, or even longer. So to find the miners rolling inventory, we look at the number of Bitcoin that are mined for the first time or generated, and those that are sent out of the mined wallet. We call that first spend. So if miners are sending the same amount that they are generating, then their inventory is essentially flat. So it's 1. If miners are building up their inventory, so you have a lower first spend and a higher generation number, then what we see is that MRI drops below 100%. And vice versa, if there's more spending taking place than there are coins being generated over a given period, well, that means that miners are pulling from inventory they've generated in a previous period in order to sell or to move them now. So the MRI is an interesting metric for gauging miner sentiment in the network. There are a lot of different reasons that miners may move their coins, and we can't say exactly what the reasons are because the data is still quite difficult to interpret. Some ideas about the reason that coins are spent for the first time are that they're programmatically being sent to mining pools, but then you would expect to see a certain rhythm of transactions taking place. Another would be that miners are selling their inventory in order to cover their costs, and again, you would expect quite a regular behavior of new coins being sold. So then that leaves us with the third option, which at ByteTree we believe is the strongest argument at the moment for this metric, which is to say that actually miners are quite revenue-driven actors. So they don't want to sell their Bitcoin unless they think they can get a good price for it. There's a lot of new Bitcoin that are mined each day, 6.25 every 10 minutes. And that's new supply that's coming into the market for the first time. So if there isn't a strong bid in the market in order to buy up those Bitcoin, then the price is going to drop. It's still a relatively illiquid market. So we use MRI at ByteTree to understand when miners view the market as strong and therefore they're selling, and when they're holding back, we generally see it as weaker. So looking at this chart, we can see MRI since the beginning of this year. What's really interesting about MRI is up until the halving period, we were typically seeing that miners were offloading their inventory. So you can see MRI sitting above 100%. As we came up to the halving, which is shown by that dotted vertical line there, you can see that MRI actually started to drop. This meant that miners were holding back their Bitcoin that they were mining, and we think in search of a higher price coming through the speculative premium associated with the halving when everybody gets a bit overexcited. What we can see as soon as halving happened on the 11th or 12th of May, the MRI started to go up again, which means that those coins that had been building up in inventory were offloaded. Another interesting pattern that we're seeing in MRI since the halving is actually the volatility in the metric itself. You can see we had a sharp increase up to about 106% in the month or so after the halving, and then a sharp decline again, down to a low of 94%, which says that essentially miners are holding coins that they're generating on inventory at one of the highest rates we've actually seen in the last years. At the moment, MRI sits at about 99%, but continues to be volatile. So the second minor metric that we like to look at is fees as a percentage of revenues. Fees are an interesting concept, and we touched on this last week. Fees give us an indication of network demand from the buyer's side, so us sending transactions, because the more we're willing to pay in fees, the more congested, or perhaps to put another way, the longer it will take to get a transaction approved on the blockchain. So we're willing to pay fees in order to prioritize our payments. What's interesting from a miner's point of view is that fees make up an increasing percentage of the revenues since the block reward halved. So miner revenues went from about $120,000 per block pre-halving to now $60,000 per block. That's about $18 million in a day across the whole network, down to $9 million a day. So as Satoshi envisioned, as the block reward halves every 4 years, there needs to be some offset for miners in the shape of fees. So fees as a percentage of the total revenues increase, and we can see that really that's been happening. So the very high peak that we can see was in fees as a percentage of revenue was initially around the halving. And that happened because difficulty dropped, which we'll move to in a minute. And therefore, a lot of miners went offline. So difficulty dropped, the hash rate then dropped, responding to that, and transactions couldn't get through. So there was a sort of plug in the network that drove fees up. But ignoring that spike and looking to the right-hand side of this chart, you can see that actually fees are trending up steadily as a percentage of revenue. Excuse me. So the last metric we're going to look at is the network difficulty. So difficulty tells us what is the total amount of computer power that's being allocated to the Bitcoin network. So you can think of this as the total capital expenditure that's gone in, as well as the operational expenditure. So you've got the CapEx, which is your machines and your infrastructure, and then you've got your electricity on the operational side. So we can see that in March, difficulty actually hit an all-time high. Before then, the sharp decline in price led to miners going offline. Profitability was squeezed, margins were squeezed, and subsequently difficulty dropped sharply. Now that's quite to be expected around halving, even aside from the fact that the price dropped, because what we mentioned, the revenues drop. So what's happened now? Well, the miners have been relentless in their pursuit of Bitcoin despite the reduced block reward that they're getting. And we can see that difficulty is now at an all-time high, which means that we have the most hash power ever allocated to the Bitcoin network. A truly exciting moment where we say that this network is continuing to grow and continuing to live on in Satoshi's vision. So that's all from On-Chain Reaction from me. We'll see you again next week. Back to you, Teana.
You've been watching Coinscrum Markets. See you next week.